We're going to do a video on price action secrets, and you never want to trade stocks without them. First thing you're going to need is some charts, and you can get them for free from TradingView. You can go to Yahoo and get them. There's a lot of places you can get them, but the first thing you need to do is get some charts. And again, we're going to start from the very beginning and show you exactly how to do this. The first thing you do, get your charts. The second thing you do is go on your chart indicators and set up 3 moving averages. Then you want to set up the first one for a 5-day, and that one's already set up. You want to color code them to whatever colors you like. The second one you want to set up for a 20-day. I do my 20 days in red. You can choose whatever color you like. And then the third one, very important, you want to always have a 200-day moving average on here, and I do mine in blue. So now you have the basics to take a look at price action. Now, we're doing this with stocks. We're going to look at daily, weekly, and 1 hour. You'll notice there's also a minute and 30-minute up here, but we're going to stick to hour, daily, and weekly. And then I'm going to show you some algorithmically generated entry prices down here, and you can use these on our website. You can buy and get them for free to compare what we're doing up here. So let's take a look real quick at this chart. We have a chart of Tesla up here. It's a daily chart. Nothing fancy about it. And again, we get them from TradingView. You can get them from TradingView for free. Just go over to tradingview.com. So let's take a look real quick and see what's going on. Now, this blue 200-day moving average, as you can see, this is the basic guideline in the stock market for following the trends. Now, why did I choose 200 days? And the answer is just convention. I didn't make it up. Anybody that knows how to do this chooses 200 days. Why did I choose 5 for the green and 20 for the red? Because this convention. A 5-20 crossover moving average system is just a classic price action tool. And that's all these are tools. They don't necessarily predict anything. They don't necessarily tell you what's going to happen. They just give you an indication of what's going on with the price action of the stock, and then you can respond. And you can put, or should be able to put, probabilities in your favor if you basically understand what the market's thinking. Now, the first thing we want to look at is the blue 200-day moving average. You can see this stock of Tesla, and it goes all the way back here till a chart of Tesla goes all the way back here to 2020, the times here on the bottom. You can see that it bounced right off the 200-day moving average. Now, there's nothing accidental about that, and there's nothing coincidental about that. You can see it bounced off it right here. It wasn't perfect, but it bounced along it all the way. Now, you can say, hey, it didn't bounce off it here, and really, it did. If you take a look at it, it oscillated around it for a long time, from February 24th all the way over to March 15th, and then rallied up. So you're not going to get perfection with these moving averages, but what you are going to get is the sentiment of the market. You can see in advance where this, then keep in mind, it's very important. You can see in advance where the 200-day moving average is. So we know today, coming in here, if we come in here, this is Friday, Friday the 18th of November, that point is there at the end of the day. So we know Monday where it is. And we know the distance between the price and the 200-day moving average is very far. And so price action on this is clearly a bear market. Anything below a 200-day moving average is a bear market. So we know that Tesla is in a weakened position. And we can see by looking at Tesla price, 176.55 was the low on Friday. That's a new low for Tesla. That's a new low for Tesla for this bear market that's been going on all the way back since the beginning. It's arbitrary where you choose it, but you can say here March, or you can say May. Wherever it broke through the blue 200-day moving average was the beginning of a new bear market. And you can just essentially say it was flirting with the bear market all the way across here from February to September. So what does that mean when we say it's in a bear market? We mean it's below the 200-day moving average. Prices are having a tendency to fall. This is a classic bull market. It's above the 200-day moving average. So the price action is above the 200-day moving average. It's a bull market, and prices will have a tendency to go up. You can essentially, for entertainment purposes only, all in my opinion, buy a stock that's above its 200-day moving average and just hold on to it and make money that way. Is there any guarantees? Absolutely not. But look at this. If you'd have just stayed long above a 200-day moving average, price action trading would have just taken you right on up. And this was 26 bucks. This is roughly $282. There are many people who just did that. That's all they did. Bought above the 200-day average. As it approached, they lightened up here. This is people getting out and new people getting in. They're indecisive. They're not predicting anything. They're just saying, hey, it's right along the 200-day moving average. Should I get in it or not? But right here, they're saying, I think I'm going to stay in it because it's still way above the 200-day moving average. So price action and the moving averages, they don't predict. It's not a predictive tool. It's a tool for sentiment of the market. Now, you can see here, and we're going to get into this more in a minute, but you can see this red 20-day moving average. it's almost straight, and the price never broke through it, all the way from here, November 17th, all the way up here to January. So all the way from November to January, almost 2 full months, all you did was buy around here at 138 and get out around 283. That's over $150 roughly, 140 some dollars. And all you had to understand about price action trading was, if price is above the 20-day moving average and everything's above the 200-day moving average, it's a really strong bull market. So price action trading is really that simple. Where is the price in relation to the moving averages, and which moving averages should we use? We should use a 5-day and a 20-day and a 200-day when we're dealing with the stock market. Now, in general, you can also use those for currency markets, and you can use them for the futures markets. There's really not a need to change. You can customize and use others, and as you get better, you can test. But if you use a 5, a 20, and a 200-day, you're going to be using what the vast majority of people who use them use. And that's what you want to do, because you want to see the sentiment of the vast majority of the market. Professionals are using these, amateurs are using these, and everybody in between. There's no guarantees that everyone's going to use them, but most people are going to use 5, 20, and 200-day moving averages. Now, you can also use, these are simples. SMA means simple moving average. You can use exponential, you can use weighted moving averages, but there's no need to do all that, because then it starts to get into, it's a predictive and so forth, and you don't need that. What you need to know is, what's the sentiment of the market? So anyone, even you starting today brand new with no information, can look at this chart and say, the sentiment is, it's a bull market. Why? Because it's above the 200-day moving average. What's the sentiment here? Oh, it's negative. Why? Because it's below the 200-day moving average. So without years of study of technical analysis, all you need is some moving averages on your chart, and you can see what the market's thinking. You can come in here for 2 minutes every day and say, okay, it's now, I was in this stock, and I was long this stock, I was long means you've bought the stock. Now it's rolled over. Now the 20 days rolling over. So that means the stock is getting weaker. And let's say you're right here and the 20-day is above you now. The red 20-day moving average is above you. You might want to take some profits here. Why? Because the price was above the red moving average here, and now it's below it. And below it tells you the sentiment has changed and it's probably going to drop. Is it predictive? No, it may not drop. You can see right here it got below it and it went all, then it broke through and went high. So there's no guarantees about anything. But in general, you can see that usually the price stays above when it's rallying the 20-day moving average. And when it's falling, usually it stays below. These are periods of high uncertainty. So you can't depend on moving averages when they start to go flat. But you can definitely use them as a tool when they're going up or down. Again, when a moving average goes flat, it's not very helpful. But when they start to go up, especially aggressively, if the price is above them, that's usually a signal the market's going to go higher. When they're below them and they're going down, that's usually a signal that the market's going to go lower. Again, none of this is predictive. None of this guarantees you anything. Now, what do you do when the price is oscillating around here? Well, it's a lot of uncertainty. Maybe you want to just stay out. Doesn't really say anything. But as soon as that moving average starts to go up, and as soon as that price puts some distance between the moving average and the price itself, you see that little gap? That means there's a lot of strength. What happens when you get these complete collapses? Well, you get complete collapses. There's no prediction here. You get those things in the stock market. But at least you know that there's an opportunity, or at least a probability that the market's going to go up in terms of using these price action tools. Now, we use the 5-day moving average for other things besides to give us a trend indication. You can see at certain times when I spread this out, the price never even touched the 5-day moving average for a couple of weeks. That tells you that the price was very, very, very strong. There was a tremendous number of buyers here. But when it touched it right there, that was a big warning sign, because look what happened afterwards. You can see conviction with moving averages. You can see uncertainty with moving averages. So conviction here, uncertainty here, uncertainty all through here because it's following the moving average. It's not above it or below it. And then you can see conviction again. Now it's below it. And then you can see the turn. It was below the 5-day moving average. Now it's above the 5-day moving average. Now it's above the 20-day moving average. But you can see the 5-day goes flat through here. And so conviction's starting to get a little uncertain again. And the 20's flat, so it's a little uncertain. And sure enough, you can see the market sells back down to it and stays around it until finally the market says, oh, we're going to go lower, and closes definitively below it. Both the 5-day and the 20-day are now above the price, and the price moves down. And where does it stop? Right at the 200-day, right here. And then it rallies up. And where does it stop? Right at the 20-day. And it bounces off down and makes a new low. And you can see it just bouncing along these 20 days. Why? Because these are artificial indicators that say, hey, this is a 20-day, maybe we should probably stop buying here and let someone else buy to prove that it's going to go up. And eventually what happens is someone else does buy. People bought here. You'll notice it closed above, the price on this day closed above the red and above the green. That little hash mark there, right there at roughly $290, $290.53 on the March of 17. That indicated to you without any doubt that the market had changed sentiment. Why? Because it closed above the 5 and it closed above the 20-day moving average, and sure enough, the price took off. There was a ton of people looking at this, and they bought it when it happened. Predictive? No. Just a tool, just like a hammer that a carpenter uses. You have to know how to use it. But you can see there's a lot of conviction here. It never even touched the 5-day. Now we're starting to get a little afraid. So it moves and it touches the 5-day and it rallies up again. Now we're getting very uncertain because we've got a lot of profits here and people are starting to take them. So it gets below and it goes down, and then uncertainty again. So that's the way price action trading is. None of this is guaranteed. But as you can see, as we just continue to move forward in a well-traded popular stock like Tesla, when it is below the red, it goes down. When the red is more sideways, the price goes sideways. When the price gets above the red, it goes up, and so forth. Again, sideways again, down again. All looking at the moving average, which, keep in mind, is there every day for you to look at. These are not something you have to wait. This is not there. If we're here this day, September 28th, you can't see any of this because this hasn't happened yet. But you can certainly see all this back history. From the 28th back, we can see it's been flat for almost a month. So we know not to pay a whole lot of attention to a moving average when it's flat. But once the green crosses below it, the 5-day crosses below the 20, that's a classic moving average signal. A crossover of a 5 over a 20 is a classic signal. If it crosses above, you may get a buying signal like here. If it crosses below to the bottom, you may get a buying signal. And you can use price action to tell you what's going on. You always want price action to confirm your moving averages. So for example, if we take this day right here, you can look up here when I highlight these prices. You take that day right here, the 27th of September. We can see that the close, which is right here, the 27th of September, the close was $82.94. I'm sorry, $282.94. So that was below. If we now go up here and start to look, we can see that was below the 5-day. It was below the 20-day, and coincidentally, it was below the 200-day. That's a classic buy signal. So what is the buy price that you want to get in? Well, it's the 27th, and it closed right here. You can see it. It closed $282.94. That's our entry price the next day. So let's just call it $283. So we go here. Can we get in at $283? Yes, the high was $289. So that's your buy signal. The close of the previous day is your entry signal today. And that's a very classic 5 and 20 crossover system. You can build a computer program, you can test it yourself and teach you what the probabilities are and so forth. And keep in mind, past performance is not an indicator of future performance, but it's a great tool, in my opinion, for entertainment purposes only. It's a great tool. It gives you an exact entry price. In this case, $283.94, we're going to call it $283 for the next day. And if you can get in, there's a very high probability, in my opinion, again, for entertainment purposes only, this market's going to go down. Why? Because we're below the 200, we're below the 20, we're below the 5, and price is below all of it. And that's a very, very strong indicator of price action to tell us the price is probably going to go down. Again, all for entertainment purposes only. You trade at your own risk. So that's how price action works, and that's how you use it for price action trading, and that's how you use it for price action trading strategies. I'm giving you all of it here really quickly, but that's basically how you use these moving averages. You put them on a bear chart. You bring up Tesla. So for instance, let's go over here and bring up Apple. We can bring up whatever we want, but this program is going to populate it for you automatically. You just put in Apple, and now you can see they're automatically plotted. So you don't have to spend hours doing this yourself. It's automatically plotted at TradeView, and all these charting companies are pretty much the same way, but TradeView is a great one. And again, we're using a 5-day moving average, a simple moving average, a simple 20-day moving average, a simple 200-day moving average. I recommend you color code them. I always go green, red, and blue. That's what I do, because that way I don't even have to think about it anymore. I know what they are. If you have other day periods of time, say you put a 40 or a 60, I wouldn't recommend that, but you can. Make sure you change the colors so your mind gets used to seeing the colors. Because eventually, over the years, I've probably looked at thousands and thousands of these charts, and you can do yourself a huge favor if you color code them. But as we spread this out, now we're looking at Apple now, and you can see, look at this. It's a tremendous rally. And how do we define this rally? It's above the 20-day moving average. How do we define this decline here? It's below the 20-day moving average. How do we know Apple's in a bear market? Somebody says Apple's in a bear market. How do we know it? It's below the 200-day moving average, the blue. And look what happened to it. It's flat. What does that mean? It means Apple's probably not going to rally anytime soon, but it's certainly not in a bull market anymore. So it was in a bull market all the way back here. It's in a bull market because it's above the 200-day. But once it started to go flat, you can see now it's going sideways. And when it gets below the 200 moving average blue, it's in a bear market. So it's very easy to understand these terms when you take a blank screen with nothing but the price and you put price action tools on top of the screen. And so that's all we're doing here. It's not hocus pocus. It's not predictive. It's just a tool that gives us very, very good insight. And as we continue to expand this out, we can see this is almost ridiculous how this worked here. Price to be just buy and stay long as it's above the 200-day. When do we get out? Well, you could get out anytime you wanted, but here's a classic signal to get out. The green crossed below the 20 and price closed below the 20 right here on August 26th. Boom, get out. Now, you do what you want to do. You trade at your own risk, all in my opinion, but that's a classic exit signal right there. You can program that to a computer. You don't even have to guess. So you see what happens once it got out? It essentially went down all the way down here to October 13th. That price decline was $163 all the way down to $134. So now, what do we think about down here? Well, we got a classic crossover right here on October 21st. We had a green cross above a red, and the price closed above both of them. Boom, went all the way up here. This difference in price, this close was $147, and it went all the way up to $157. So it's a $10 rise there in about a week, $10. So that's again very simple price action. Use these moving averages as your tools to discover what price action is. But you can teach yourself this very quickly. You just continuously go through here, put in your big, broad stocks. I'm going to put in Amazon, and you can see the computer, that's the wrong Amazon. The computer always make sure you pull up the major exchanges like the NASDAQ and the New York Stock Exchange. This is the correct Amazon because there's a lot of offshoots. But again, let's take a look at Amazon because it's very interesting. We can see that Amazon, when the 200-day moving average was flat, look what the price did. It just stayed flat. Now, every single day you come in here, you're going to be able to see in advance. From yesterday, you're going to see it was flat for the past month. It's probably going to be flat today because this 200-day takes a long time to start to change. So you can see it's flat here. Now, this is why it's important to have faster moving averages like a 5 or a 20. You can see it was flat across here for a 200-day moving average in blue, but look what happened to the 5. It skyrocketed, and then the 20 followed it, and then it collapsed down below. That told you the uncertainty is leaving. This tells you money's pouring in, and there's no longer this flat. Now people are making decisions. And so that would have given you a heads up to say, hey, if this price gets way above this, I'm probably going to buy in here somewhere, again, for entertainment purposes only. And you could see that once it got way up here, everybody jumped in, and from about here all the way up to roughly here, this is a lot of money. This is 118 or 120 all the way up to 150. That's $30 a share. Just stay in it as long as it's above the 20-day moving average. When it started messing around right here, get out. You don't have to try to predict this. Just get out. It's $30 you could have made on this stock. People spend their whole lives trying to make $30 on a stock trade. So again, all for entertainment purposes only, all my opinion, and you have to trade at your own, with your own analysis and use your own judgment. But in general, these 20-day averages are extremely helpful for price action trading, and you put them in relationship to a 200-day moving average. A 20-day above a 200-day, we're looking at a bull market, right? A 20-day below a blue 200-day, we're looking at a bear market. Look, check this out. I mean, that is a classic sell-off with a 20-day moving average below the green, below the red. That's a bear market. Just no getting around it. As soon as it goes flat, we get the heck out. Great traders might day trade this through here. We're not talking about that. We're talking about using price action to make decisions that aid us in our whatever we want to do, trading, investing, and so forth. And we can do that really simply without years and years of study by understanding that price action can be objectively looked at by placing a 5, a 20, and a 200-day moving average on top of any stock chart. Let's check one more before we end. Let's check one that is not so easy. Let's check NIO, which is a stock a lot of people know about, but it's not easy. Let's take a look at this chart. Now you can see here, this is a relatively low-priced stock, and it trades a little funny. But we don't have to know a whole lot about that. We just know that once it got above its 200-day moving average, it just skyrocketed. Now, how do we know it was going to do that? We didn't know it was going to do that. But we did know that it's above its 20-day moving average. And you just stay with it. Now, it touches here, get out. Just sell out of it. And then if you want to, you can buy back here and stay in it. And when it goes sideways, get out of it. When it gets below the 20-day moving average, you could, I'm not recommending you short it, but maybe you buy some put options on it. Professional traders would consider shorting it. So it comes down to its 200-day moving average. You'll notice it's rising. It makes huge difference. Are the moving averages rising or falling? This moving average is still rising. And that's why you saw it trade through it and come back above it. As it started to crest, that's when it went into a bear market. And you can see they were very uncertain because it had just crested. But now it's completely crested. And they're pushing against it and they can't get above it. So the market sentiment is negative. And the 20-day and the 5-day get below the 200-day, and this stock stays in a massive bear market from November 21st all the way down to where I'm going to show you if I can get it to move, all the way down here to where this stock put in a low the other day of $8 and some change, all the way from $41. So this stock lost more than 75% of its value in the last year and a few months. How would we know that was at risk of happening? We're below the 200-day moving average. It doesn't take a genius. You don't have to watch TV for hours. It's below the 200-day moving average, and we have a downward sloping red 20-day moving average. That's a huge bear market stock, and we got to be very careful if we want to buy that stock. Can you make money buying it down there? Sure. Somebody made money going here. Somebody made money buying here, but very dangerous. It's very tricky, even for professional traders. But as a relatively unskilled investor, or even a highly skilled investor, it's below the 200-day moving average, and the 20-day is sloping down. It's a bear market. It's above the 200-day moving average, and the 20-day is sloping up. It's a bull market. So your probabilities, hypothetically speaking, are vastly better if you trade in the directions of the major moving averages. Is it going to always be correct? No. Is it usually correct? No, you test for yourself. But you can also check and put in as many of these as you want to, and you can see for yourself that I'm not drawing these. These are being drawn for you by the computer. This is Ford. What did Ford do when it was above its 200-day moving average? It skyrocketed. What did it do when it was below its 200-day moving average? It went down. What did it do when the moving averages were roughly flat? It pretty much stayed roughly flat except for these crazy spikes. Pretty much stayed flat, right? So we're going back here for a lot of years now. Below its 200-day moving average, it went down. Below its 200-day moving average, it went down. Did we have these rallies? Of course, you're always going to have counter rallies and a decline and so forth. But in general, above its 200-day moving average, it went up. And of course, you want to make sure that you understand that the first crossover is what's really important. It crossed over first here. That's when people are going to buy it. And this stock is a low, relatively low. You can see Ford through here was in the $4s, $5. These prices, these kind of stocks are always harder to. They're very jerky. But you can see in general, it was above its 200-day moving average, so it went up. And again, it was below its 200-day moving average, so it went down. So this is all price action. This is how you do it with a 5-day, a 20-day, and a 200-day. I'm not trying to simplify it, but it is very simple. If you keep it simple, it's a lot easier to understand. And that's price action, and you can call it whatever you want. Price action trading strategies. And that's how to trade. Now, you can use our information to help you do all this. RBM Research puts out 190 stocks. We use algorithms to generate the entry prices that we put out, and we put them out. These are out from Monday, November the 21st, and we change them every Monday through Friday before 7 a.m. They're out for 1, 5, and 20-day hold periods. You can use these to give you an idea of what's going on, and you can combine it with your price action analysis up here, and they're all available for free. We cover the stocks, 190 stocks, the major forex pairs, the most liquid futures contracts, all by 7 a.m. at rbmresearch.com. There's a link in the description below. You can follow it over there. Access is free, no credit card required. You get a free 14-day trial. Keep in mind, you can use price action trading strategies, moving averages on almost everything. Stocks, forex pairs, crypto, and futures contracts. You always want to make sure if you're dealing with futures contracts, that they're very liquid, and that's why we have these four here. The S&P, crude oil, gold, and treasury bonds are pretty much the biggest futures contracts, but the moving averages work fantastic on them. The other thing that we didn't cover, and we need to cover it real quick, I told you we'd do weekly and hourly. Let's take a look real quick because it's very important. You can do the same thing on shorter or longer period charts. This is a daily chart of Tesla. Here's an hourly chart of Tesla. You'll notice it's if I hadn't told you that was an hourly chart, you would have a hard time knowing it. But that's an hourly chart, and the same rules apply. So below the 200 hour, pretty much thinking it's going down. Above the 200 hour, pretty much thinking it's going up. So the question is, could you day trade with these? Oh yes, you definitely could. For hypothetical purposes, for entertainment purposes only, all in my opinion. But if I was looking to day trade, I'd have these charts on my screen. Now let's go to the weekly. Same thing. This is a weekly chart of Tesla, and when you use multiple time frames, it's extremely interesting. So let me show you. Tesla's in a bear market on an hourly chart. It's below the 200-hour moving average. Tesla on a daily chart is a bear market. It's below the 200 daily moving average. Tesla on a weekly chart is not in a bear market. It's selling down horribly, but this is the 200-day moving average. So Tesla long-term 200 week. This is a 200-week moving average, and it's still above it. That's a very important piece of information to know if you're trading in Tesla, because it means this point right here, $160, might be a really good idea to pay attention when Tesla touches that, if it does, because a lot of people around the world are going to be watching that to see if that's going to hold up, and maybe that's a new buying opportunity for Tesla. So you can have a stock that's in a bear market in a 1 hour or a 1 day, and not be in a bear market on a weekly. So whenever you're using these moving averages, you want to make sure you follow all those. You can use hour, weekly, and hour, daily, and weekly. And of course, if you're going to trade commodities and get into this, you get into the minutes. Stocks, I don't think this is a 1 minute for stocks, and this Tesla is a very actively traded stock. So you can use some of this on a stock, but for the S&P 500 futures contracts, I have them on my screen all day long in the 1 minute time frame all day long. Same exact thing, 5, 20, and a 200-day moving average, but 1 minute bars. So that's price action across time frames, which is very important. You want to make sure if you're going to enter a trade that if the stock was in a bull market on a daily, you want to make sure it's in a bull market on an hourly. Otherwise, it's just going to go down $1 or $2 or $5 on you, and if you waited, you could have got a better price. So you use shorter and shorter term charts when you go to enter the market, and you use the same price action indicators, 5, 20, and 200 bar, and you just set them up that way. Once you set them up on these trading view charts, you can see what I'm doing. You just switch the time periods, and they automatically switch for you from daily, hourly. It's all the same. These are just 200 bars, and the time of the bar is what changes. So that's basically price action and how you use it. Very simple. And again, you can get access to everything we put out at rbamresearch.com. Link in the description below. You trade at your own risk. Everything I've discussed is for entertainment purposes only, including entry prices and my commentary. You can't use it for anything other than entertainment. You should always do your own analysis, and hopefully you'll be able to use price action to help you do that. And you definitely trade at your own risk. If you like these videos, we make custom videos, and we can make one for you. There's a link in the description below if you want us to do that for you. If you like this video, please click the like button. If you want to, please subscribe. And if you have a great comment on this video, please leave it in the comment section below.